trial session. Thank you.
You can hear me.
Can you hear me? Good afternoon, everybody. If you can hear me, kindly let me know.
Yes, we can hear you.
Okay, great. Thank you very much for this particular opportunity to present to you this in this good occasion. And I'm highly honored to be with you this particular evening, afternoon. I know it's afternoon in Ghana, and it's great really to be invited to speak. I would have really appreciated to attend this in person, but due to very many other reasons, I was not able to attend. So I'll just basically take you through the slides, and I hope that you can be able to see my face on your screens in Accra. Accra is a great city that I always want to be there, but unfortunately I couldn't make it. So I want to talk about ESG, and one of the key things that really comes in mind is that this is quite a new context that everyone is talking about. It's the new buzzword in town, and I think I would try my level best to talk to you on the considerations that we need to take in this particular market or in this particular continent. So I'm a senior manager for risk regulations at FSD Africa, and FSD Africa is a development agency that supports financial markets. We ideally make finance work for African future, and we are funded by the UK government through the UK Aid, and we are a team of financial experts across about 70 financial experts across the continent that work in different aspects within the financial markets industry. Right, so I want to talk about ESG, and basically to bring this into context, we need to look at where Africa is, particularly on vulnerability of this particular continent. Thereafter, I'll talk about climate finance. What role should we play as a sector, particularly the insurance sector, the capital market sector, but also generally as professionals within the actuarial space? What should we be able to do? Then maybe talk about what we are doing, particularly to support ESG, the projects that we are currently undertaking, not only in Kenya. There's a project that we are currently running in Ghana and Nigeria, and it will be great that I'll kind of talk about that, what outcomes we are looking to achieve, but also a declaration that was made some time back in April last year towards sustainability, which we've been working together with UNEP PSI. So we are basically at a very, I would say, difficult position as a continent, because Africa contribution to global emissions is quite minimal. Yet, in terms of the economic and geographical factors, it basically makes us one of the most vulnerable continents. It's kind of stated that out of 30 of the 40 most climate vulnerable countries are in sub-Saharan Africa. And ideally, talk about Ghana, talk about Nigeria. There are a lot of elements around flooding. But also, if you talk about where I come from, Kenya, there's also a lot of issues on either flooding or drought that do impact different parts of this particular continent. Now, around 30% of our GDP as a continent might go down by 2050 if we don't really address issues around climate risk. Over and above that, 23% of our continent is highly dependent on nature. That means that we really need to ensure that we become a country that doesn't, a continent that does not expose this continent to biodiversity loss. Now, over and above that, only 3% of the global green finance comes to Africa. So there's need to see how best we could align ourselves to get more funding, particularly on aspects of green finance. Now, if you talk about insurance, and these are an element that most of us are really concerned about, is that insurers always look into protecting life and really ensuring that there is development. And with that particular context in mind, environmental, social, and governance issues do impact different sectors in very many ways. So for instance, there is elements of economic growth that will be highly impacted when it comes to the environmental issues, particular climate-related risks. We are currently talking about social issues, the diversity and inclusion component, such as we've seen an advent of things such as social bonds, but also just governance issues that really needs to be taken care of. So these are really increasing costs around how then do we invest, how do we look at issues of urbanization, but also particularly on the changing climate that we are currently experiencing in this particular continent. So this kind of impacts different components such as government costs, what governments are really putting into addressing disaster risks. We've seen farmers and herders kindly impacted by climate change, homeowners in terms of flooding. That really impacts even the costs of property, but also around the people that really are highly vulnerable, such as the people that fall at the lowest of the pyramid. Earlier today, I saw a presentation on microinsurance, and that basically shows you that financial inclusion is one of the key components that really needs to be discussed in this continent. Now, out of that, we've seen a number of risks, and climate and nature-related risks was one of the top risks that we needed to think about in 2021. So for instance, climate action failure, issues of biodiversity loss, issues around human environmental damage. So basically, if you look at that, climate and nature-related risks are the biggest long-term risks that we need to think about. And all these kind of encompasses around issues of sustainability and what we are currently talking about, issues of ESG. Maybe on top of that, you could think about infectious diseases such as COVID that also kind of managed to come one of the top risks within the year 2021. So the key thing is then what financing comes to Africa. So in terms of our share of global climate financing is far too low, and there is need to kind of look at how we could address this issue around inadequacy of financing, particularly to address issues around transitioning to low carbon. So for instance, between the year 2017 and 2018, about $546 billion was invested on combating climate change. And that was quite inadequate compared to an estimated amount of 1.6 to 3.8 trillion that was needed to achieve our transition to low carbon. Over and above that, Africa is in the need of really getting adaptation financing, but we only managed to get around 7% of climate finance globally directed towards adaptation. Now, mitigation and adaptation are two common things that we might need to think about as a continent, but we might need to get more in terms of adapting our environment and even adapting our practices towards low carbon transition. Over and above that, most governments in Africa are not really adequately funded, particularly from the public sources. And that basically means that there is not enough money to really direct to the opportunities that will kind of enable us adopt to green investments and even just transition to a more sustainable continent. So what is the opportunity that we have as a continent? Now, there's substantial financing commitment towards green, and we could see around that means that, yeah, there's a bit of opportunity around that. If you look at the Glasgow Finance Alliance for the Net Zero, it has committed around 130 trillion to basically push towards green investment. And in this, we've seen around 3 trillion opportunity in Africa by 2030. So it basically means that there's quite opportunities that we kind of see coming towards Africa. Also, COP27 will be held in Africa. In this time, we are going to have COP27 in Egypt. And that basically shows that we should look at how then we increase our focus on resilience and particularly on nature. Also above that, we've seen enabling environment cutting across different parts of the country, parts of the continent. So for instance, I'm aware of very quite interesting policies that have been issued in countries such as Ghana. We've seen a lot of policies in Kenya that basically gives us an indication that there's a lot of traction around creating an environment that will really focus on making Africa more resilient and more sustainable going forward. Also, there is a coalition of Africa Green Finance, and this basically brings in together different bodies and institutions that really look into supporting green finance. And we've seen that this particular coalition having very interesting, I would say, agreements and policies around what really needs to happen in Africa. It's something that all of us can check, and it's something that it will be great to get more champions around the African Green Finance Coalition. So the key thing then that comes in our mind is then how can climate change threaten the financial sector? And I'll be able also to look at how then this connects to what we were speaking this morning, particularly on risk-based capital and what basically financial institutions would want to hear. But just before I do that, climate change is quite structural, particularly on the economy and for the financial system. And that basically gives us an ability to look at what we are always aware of, the balance sheet, the revenue, the income statement, and kind of reflect on what risks does climate pose to those two key financial instruments. Now, for instance, we'll talk about physical risks that basically come from extreme weather events, and also gradual changes of weather will kind of cause a number of things, such as business interruptions, or basically might cause underwriting losses if you look at it from the financial system. There are issues around climate, around the transition risk that basically comes out of the policies that are currently being developed. So for instance, we've seen a number of policies coming up in terms of really trying to inhibit brown instruments to more green instruments. We've seen issues around technology, customer preferences, whereby customers are now looking into more green, investing their resources into green instruments, but also in terms of the liability that will come out of the transition. So In this case, then we kind of will be able to see a bit of reconstruction coming through, or maybe issues around reinvestment, because you might not really want to invest on green components. But in terms of the financial markets, what we might see is a financial market losses, particularly on some instruments, say talk about equity, bonds, and other commodities. But also on the liability risks, which basically will come out of people seeking compensation from both physical and transition risks. So this kind of really imposes us to different components, and we might really need to think about as a continent, how then do we ensure that as we green our financial system, we are able to address these important risks that come out of issues surrounding sustainability. Now, maybe importantly, we might need to think about some of these items in the balance sheet and also in the income statement, and some of the risk factors that will be importantly considered, particularly given that very many jurisdictions are trying to move to more principle-based approaches when it comes to capital determination, but also ideally adopting different regulations that do impact on the well-being of a financial company and also on the shareholding of different capital providers. Now, there's one thing around asset values, and this is something that I'll be able to demonstrate how when we talk about ESG, particularly climate-related risks, how will we be able to see an impact on asset values? There'll be an impact on insurance liability values, but also on the capital position. And that really, again, resonates with what was discussed earlier on a risk-based regimes that we were able to see earlier today. But also in terms of the income statement, premium revenue might change, particularly on the customer preferences. Are we able to provide more sustainable products or sustainable instruments that customers would want to buy? At the same time, in terms of the investments, where will we be putting our investments? Is it on social bonds? Is it on green bonds? And are these particular instruments available? And what return are they likely to fetch? But also on the insurance losses, particularly on extreme events that might arise, such extreme climate-related events that might drive some of the losses. Now, in terms of the risk factors, we know that when you are determining your capital factors, there are different risk factors that are always thought about. But are we going to look at other components such as the probability of occurrence of weather-related events? I know this is highly captured under catastrophic risk factor, but further to what is really happening towards climate change, will we need to have an additional factor around this? Issues around severity of weather-related insurance claims, but also on the credit rating, given that now institutions are trying to be more sustainability compliance and looking into issues of adopting ESG and trying to release ESG reports. Will it impact on their rating going forward? So these are some of the factors that will, in one or the other, impact on different risks that we are always conversant about. Now, let's then look at what we are aware of. Now, the first thing we talked about physical risk, and this is basically out of different elements that we might need to think about, and maybe just think about issues around melting ice caps, increasing sea levels, floods, and other components that are needed. We might need to kind of focus on issues of insurance risk that might come out of higher than expected insurance claims payout. There is also a component of market risk. And in this case, then what you need to think about is that some equity values might fall due to the physical losses that might come about to do with things such as flooding or business interruption that might also impact portability on some farms. So think of maybe you've gotten a corporate bond on a particular institution, and this institution is impacted by business interruption risk, or maybe you've invested in particular properties, and this area is very prone of flooding. So ideally, there will be some fall of values of these particular properties, and that's how then we might need to not only look at the illiquidity nature of maybe property, but also think about these particular occurrences as we'll be determining maybe exposure to things such as capital, but also just looking at the balance sheet of an institution going forward. Also, there's issues around credit risk, and in this case, then there might be some downgrade of credit rating of particular reinsurers, and this might mean that for those particular companies that might have been less diversified, then you would be exposing these insurers to reinsurance losses. So it will be very important also, just over and above just think about diversification, but there's need to look at the downgrade that might come out of these physical risks that might be brought in by climate-related risks. Over and above that, operational risk, and here damage on insurance offices, disruption of very critical functions. You know, most of the time, operational risk is taken as a flat rate or maybe computed based on all the other risks. And do we really need to maybe add another factor just to take care of these physical risks that might arise out of physical damages of different components within an insurance setting? But over and above that, there is issues around liquidity risk that might basically turn out of the higher policy cancellations to policyholders due to the loss of income, which might be attributed to these physical risk issues. Then maybe if you look at the component around transition risk, and what basically comes in mind is that over and above what we currently do as actuaries, and when we are looking into determination of capital adequacy, we might really also think about basically stress testing some of these factors to see the exposure of a financial institution to these particular risks. So for instance, we talked about transition risk basically arising out of the change on policy, change on government policies, maybe carbon tax in reducing greenhouse emissions and such kind of things. Now, that would come a long way with the risks that we currently recognize when we are computing our risk-based capital. So for instance, insurance risk, and this will come out of potential underpricing of new insurance products, which will be intended to cover green technologies. And so for instance, assume that you want to cover a plan that basically is focusing on renewable energy, such as solar or wind or geothermal. We might not have adequate data, and that might lead to maybe some form of underpricing of some of these new insurance products, or maybe overpricing and such things. And the biggest risk will be coming out of underpricing, and that will have a direct impact on the business. Because in this case, then you might expect your losses to be higher than what you are intentionally priced. Issues around market risk. Think about investment losses due to lower asset values from stranded assets. Some assets might be stranded in the future, and that means that if an institution will look at their balance sheets, some assets might be out of their balance sheets because they kind of will be more brown assets or something like that. So how then do we look into issues of these assets and loss of value of these particular assets? Credit risk, whereby losses will arise out of corporate debt in instruments due to forced transition or legislation, and these will highly depend on corporate investments that institutions have done, and we don't really know where the legislation will take us. And with that, then there's need to kind of just look at how this transition will happen. Over and above that, operational risk, which basically comes out of exposure to cyber risk, if insurers tend to move to a paperless operating systems. These are risks that is highly currently talked about, whereby also we want to get more institutions appreciating the use of technology as a key component on driving business processes. But also in terms of liquidity risks, such as political and societal pressures to invest in illiquid long-term green infrastructure instruments. Interestingly, I came across an article whereby one customer had assumed that the financial institution had invested on green instrument, but ideally the company went ahead and invested on more liquid instruments such as term deposits and government treasury bills. And when that customer realized that, he was quite frustrated by that investment, because the customer really wanted to get high investment into green instruments or green bonds or something like that. So greenwashing and such kind of issues might occur, but also in terms of how society might perceive this will have a very big you kind of put your money into more long-term green infrastructure instruments, then illiquidity might be an issue that might come into perspective. So maybe just to look at some of the top challenges that are currently facing different institutions when it comes to climate risk. One of the key issues that was mentioned was lack of data, and there's need for us to kind of start thinking about data as professionals, but also just aligning our businesses processes to kind of look at how we could quickly start generating data that will address sustainability going forward. Also, there is lack of expertise across the continent, but it's something that over time we will be able to see how then we create more capacity, we build capacity around this. Common language is really, really important because we need to ensure that as we develop those ESG reports, they should be comparable from one institution to the other. So how then do we develop these taxonomies just to ensure that, yeah, you could be able to compare companies across board? So there are so many factors, but yeah, I'll just base my my discussion on those ones. But then what basically comes in mind? What is the role of our sector? Now, the financial sector really works across two components, more capital managers, but also risk managers. And this will have a very critical role in basically driving the climate change mitigation and adaptation, but also towards transitioning to a nature positive future. Now, we did mention that if we don't really deal with climate related risk as a continent, we might lose up to around 30% of our GDP by 2050. But also as a continent, 23% of our GDP is dependent on nature. Then we need to ensure that we support our transitioning to a more nature positive future. Then the question is then, why are we increasing emphasis on green finance? And does it really make sense? The thing is that, yeah, we are vulnerable and Africa really needs to respond. However, this response has been slow because of massive financing and technical needs. But where do we foresee? What do we foresee is that we really need to kind of start building our policies and regulatory frameworks for green finance, which is currently inadequate, and kind of slowly start pushing our investments toward green bonds, which basically has been quite slow in the continent. Secondly, more than half of African countries have had problems mobilizing both international and national climate finance, and less than a quarter of these particular countries have a strategy in place to deal with issues on climate financing. Further than that, there's skills gap both in public and private sector, and that means that we might lose more opportunities into the future. Overall, we have only around 19 direct companies that have direct access to Green Climate Fund. And basically, this means that we might need to kind of put more in terms of getting more entities getting access to the Green Climate Fund towards mobilizing the future of Africa into sustainable future. So we've, as FSD Africa, we've been working on an ESG integration with the insurance regulators in Kenya, Nigeria, and Ghana. And we've been honored to work with NIC, the National Insurance Commission in Ghana. And what we are trying to do is we are trying to engage the regulators to ensure that we both look at the risks and opportunities that come out of ESG. And in this, then we will be able to ensure that the considerations of ESG become more relevant and enable them monitor the industry in terms of enabling them not only to address the current prevailing issues, but also look at the broader societal risks. So for instance, issues around climate change, but also issues around poverty. And this is well aligned to the United Nations Environmental Program, Principle for Sustainable Insurance, that really looks at issues that will adapt our approaches towards creating a context to the frameworks that we are currently looking into adopting. So it's a privilege that we are currently working on this particular project. And I know in the next couple of weeks or months, we should be able to see results really coming out of this. So what are the objectives of what we are currently doing as an organization and working closely with these institutions? We want to basically establish perception and capabilities of the African insurance industry towards addressing ESG issues and kind of even putting that through their operations and strategy. We need to look at how the underwriting practices are looking into issues of ESG, how the investment strategies and also the capital strategy is kind of aligned on ESG. Secondly, we want to support actions and initiatives and build insurers' technical capacity. And in this, we will be conducting trainings, not only to the regulator, but also we'll be working closely with insurance companies in Kenya, Ghana, and Nigeria towards building their capacity and supporting the initiatives that will drive the industry operations and strategy. Further than that, we want to launch a coalition of industry champions. We'll advocate for stronger ESG considerations by the African insurance industry. We did initiate an ESG task force in Kenya, and I'll be able to kind of take you through that as we progress into this discussion. We are going to look into maybe also creating an ESG task force in Ghana, and this particular task force is headed by the Actuarial Association in Kenya, the Actuarial Society, or the Actuarial Association, the Actuarial Society of Kenya, but also really running with FSD Africa to create that change that is necessary. Over and above that, we want to build an enabling supervisory environment for ESG regulation and disclosure, because without really providing a very clear channel around guidance and policy, then we might not really manage to address the outcomes that we really want to achieve. So in terms of the execution, we are looking at diagnosing, looking at the current state of ESG related trends, but also just looking at the context and where the institutions are on ESG in those three countries. Further than that, we'll equip in terms of developing a framework and toolkit for identifying and assessing ESG risks, and integrating those risks into management towards underwriting, capital adequacy on these insurers and also the regulators. Further than that, we will integrate in terms of conducting capacity building and training and developing a common understanding on ESG. So it's more a very holistic approach that we are looking to adopt in terms of really supporting regulators and even the insurance industry within these particular countries in integrating ESG into their perspective. So we will kind of provide a gap analysis report that will be available for us to share out of this particular project. We'll kind of look at how then do we create a fit for purpose regulations. In this case, we want to develop fit but proportionate ESG toolkits within these three regions, but also just continually engage and advocate for change management towards ESG adoption. Last year, we did come up with a declaration, and this is basically the Nairobi Declaration on Sustainable Insurance. And this is a commitment of African insurance industry leaders to support the achievement of United Nations Sustainable Development Goals. So we've been working and really supporting this cause. We've gotten close to 18 signatories, basically signing to the Nairobi Declaration. And basically what we are looking at is having a shared vision that will end poverty, rescue the planet, and build a prosperous world. And we need to basically accelerate issues that do impact sustainable Africa. So for instance, climate change, biodiversity loss, ecosystem degradation and pollution, but also just looking at human rights violation in terms of the social bit of it. Over and above that, we will work with risk managers, insurers and investors within the African insurance industry in promoting both economic, social, and environmental sustainability. In this case, how do they advance the assessment and management or disclosure of climate-related risks, and how do they advance assessment and management and disclosure of ESG risks and opportunities across different lines of business. So we want the insurance industry and even other practitioners to take a lot of cognizance on their role as risk managers. The second component is on the insurance piece. How then do we support insurance sustainable development goals, the SDGs? How then do we close the protection gap that is always increasing? So for instance, right now we are talking about an insurance penetration rate of around 2.78%, which is really lower than what we term as a global average of around 7%. So as a continent, there is need to kind of look into promoting inclusive and innovative insurance solutions. It was quite interesting to really see the presentation on microinsurance, because that is one of the tools that will kind of go a long way of promoting inclusivity and financial inclusion within our systems. Further than that, there is need to look at the insurtech and developing nature-based solutions. We've been working predominantly on tech side, where we promote accelerators, particularly the insurance accelerator, and we managed to conduct an insurance accelerator session in Ghana together with the National Insurance Commission, which we dubbed as the InnoLab Insurance Accelerator program that we managed to close, I think, last month. Over and above that, we look into supporting transition to resilient net zero emissions economy, and that kind of gives us an opportunity to see how we could advance support of more green related instruments and investments. Over and above that, we want to look at how then we will need to transition to more net zero emissions economy. And in this, we've seen various companies working towards joining the Net Zero Asset Owner Alliance. Further than that, I did talk about the ESG Africa Task Force. This was initiated in Kenya, whereby we work with the Actual Society of Kenya task. And as FSD Africa, we've been leading this course. And we want to guide African financial markets in creating a sustainable future. So the ESG Task Force in Kenya is currently looking at how do they drive and support readiness of the financial sector in managing ESG risks. It will be great to see how we could also initiate the Ghanaian chapter of supporting this cause, and it will be great for us to really work with the Ghanaian Actuarial Society towards making this a reality and building a sustainable future, not only in Kenya, but also looking at how then this becomes a reality in Ghana. So the task force has so far managed to work around developing 5 work streams, and these particular work streams work on issues such as research and innovation. And this is basically looking at analyzing issues on climate change, physical, transitional, and liability risks. But also they are working into setting a green lab, which will look at various innovations that will support the financial sector. The green lab will look at things such as various products and services that will, in one or the other, address the risks that are currently impacting the continent, and also just zeroing that down to Kenya. Further that, there's a work stream on reporting and disclosure that works into kind of guiding the industry towards ESG reporting and disclosure guidelines and developing frameworks, but also just looking at issues around taxonomy, because we talked about a common language, and that will really need to be done with a lot of, I would say, awareness creation, but also just discussions and collaborations within the industry. There's also a training and education work stream, and they just deal with educating the stakeholders, the regulators, towards ensuring that we kind of enable knowledge to be disseminated within the financial sector. Also, we have a team that works on policy and regulations that supports the development of ESG policy and regulations, and they work closely with the different policymakers and regulators in Kenya, just to ensure that as they think about policies that do touch on issues of sustainability, the actuarial society, but also the professionals that are working in this particular task force are even available for comment and providing direction. Over and above that, there's an engagement team that basically supports the PR activities and engages different stakeholders towards net zero campaigns and Nairobi declaration. So we've kind of highlighted different aspects that we are currently working on, and we are really, really looking forward to see how best we could work with the players here in Ghana, just to ensure that we do support the cause. So I would want to stop at that and let me know whether there are questions. I'm happy to address or basically answer a few questions that you might have. Thank you very much.
Thank you, Elias. Shall we clap for him? Thank you. Are there any questions? Right.
Hello. Hi, thank you for your presentation. ESG is definitely important to any society. So I wanted to spend time on the S, the social equity piece. And I think there is a lower hanging fruit that was not discussed, which is on education. And I'm not talking about just training people about ESG. I'm talking about the low level of human capital of the average African. And I think it poses the greatest ESG threat. Even the climate challenges that you delineated will not be able to be solved if we don't have the right human capital, right? And so I'm thinking, so when you think about education, it has been delegated to the government, but I'm thinking that this is one of the few initiatives that we can galvanize the corporate sector, right, to dedicate a tiny fraction of their profits towards educating the African child. And I'm trying to see what you think about that.
Elias? Hello?
Yeah, I think that's a very good interjection there, and truly there is a lot of inequalities around the level of literacy across Africa, and as you rightly pointed out, there's need to kind of just also put some efforts around that. I know we've kind of been putting a lot of emphasis on educating the culture and all that in different aspects. But it will be important for us also as professionals and institutions to look at the social side, which is basically education. So I cannot really say that we need to kind of give little attention to the social bit or the governance bit. In fact, Africa also, issues around governance has been one of the greatest impediments that kind of even impact the sustainable future. Talk about issues of corruption, particularly both in private and public sector. So governance is also an area that we might need to really think about. Now, the key thing is that when you look at socio and governance component of ESG, Africa seems to have already done a bit of policies and have very nice papers on that particular end. So there's need to kind of actualize that and get more institutions kind of looking into how they need to put actions into practice. Now, in terms of environment, there's still quite a huge gap that needs to be addressed. There's mostly, if there's anything that is existing, is minimal, but some areas there is nothing that is existing at all. So I think there's also need to just work on the environmental component, given that there's quite little attention that is also happening on that particular front. Thank you.
Thank you for the presentation. My own is like a contribution, a question. When you look at the green bond as a source of climate finance, its issuance by usage of proceeds in cumulative volume in USD from 2010 to 2019, the statistics is that 23% of these green bonds are actually going into renewable energy, 90% goes into energy efficiency, 14% goes into clean transportation. This statistics is actually from the International Renewable Energy Agency analysis based on data from Environmental Finance and Bond Database. So when you look at all these sectors, these are the sectors that Africa are not doing well. When you look at renewable energy in Ghana, our source of power is from coal. Our source from power is from maybe our water bodies. We are not doing so well in renewable energy. Neither are we doing so well in energy efficiency and clean transportation. So you said that Africa has a problem in mobilizing international and national climate finance. Of course, there will be a problem because these are sectors that Africa are not doing so well. So if the African society had to go more into renewable energy, they have to go more into energy efficiency and clean transportation, I think we can go into the bonds market and we will have a lot of funds to cater for for climate finance or in any other related sustainable project. So as you are on UK Aid project and FSD Africa, I think you can also join with most of the governments to go into such sectors to help mobilize funds for sustainable development goals. Thank you.
Thank you. We'll take one more question if there is any, please.
Elias, thank you very much. You've touched, though you didn't talk on it on the presentation, but you touched on it right now. But I would like you to elaborate more on it. The G, though you talk more on the E and then some on the S, but the G, because I was expecting some of the factors or variables that we should look out for when it comes to the G, because I was thinking that in Accra, we do have a lot of flood and others. By my village, for example, they don't have those major things. But the issue you mentioned, like corruption and others, because there's this idea that in the pension industry where there has been that the trustees should take what we call professional indemnity for the trustworthiness of holding people funds, but the ants pro that, so people have not taken such policies, and this is where the G, can play a role, to protect people's assets that people are actually handling. And I'm sure if you recently see the collapse of banks and all these things that have happened, the G could have helped us some way, somehow. So I would like to get your thoughts on those when it comes to these ESG variables. Thank you.
I will tell you, we have very good or maybe also in government. But the challenge is that some of these practices are not adhered to in terms of maybe how the board is managed, how the management is managing itself, how maybe the shareholders are running various institutions. So this basically comes out of those unethical practices predominantly in Africa. What we need to kind of really address when it comes to governance is issues around corruption or not really observing the code of conduct. So that's an area that we have challenges on. But the best thing is that, we might have very good guidances and policies that would, in one or the other, adhere us to adopting good corporate governance practices. Now, that will kind of away drive these other risks. So think about environmental, think about social factors. So if there are no good governance practices, that would directly impact these other components that we are talking about on ESG. And that might have a very long-term effect to maybe an institution's well-being, but also to the governance, to the government well-being. Now, maybe let me give you an example. There was this article that I read. It was on the Financial Times, whereby an institution had indicated that they are ESG compliant and they were providing products, and they told their customers that all these particular products will be invested, or all your investment will be put on green instruments. But they didn't do that. But in terms of disclosure, in terms of the information that they gave out, they were basically telling their customers that we've put your investments on these green instruments. That basically tells you that there was a governance issue around that, whereby now you see this becomes an unethical practice out of the well-being of this particular customer. So it's an area that needs to be addressed. We need to start thinking about it as a profession, but also just as a body that will really ensure that even as actuaries, we do align ourselves to the actual code of conduct and ensure that all the issues that we do provide or the advice that we do provide do fall to the governance practices that we should be able to adhere to.
Thank you very much. Elias, I think that we've done justice to the topic. It's been very engaging, and maybe tomorrow if you have the chance to join us again via Zoom. Thank you very much. It's been very engaging.
Thank you, and I'm looking forward to really get Ghana joining the ESG Africa Task Force. I'm happy to really take this forward and get the Ghanaian team fully on this particular course. Thank you, and enjoy the rest of the workshop. Thank you very much.
I think we should give you a round of applause, right? Well, glad to be back. I had to step out for a good reason. We are late in the afternoon, almost breaking into early evening, so we may have to hasten in our deliberations. The scheduled plenary session, which is next, was originally scheduled for an hour, but we'll have to do this in 20 minutes. The area for discussion is emerging actuarial practices, the stakes for actuaries, and this we'll have panelists in banking from Mike Tichariva, Indumnuso Mavimbela, who's an expert opinion and litigation calculation, and then Yvonne Palm, African Re. So if they are here, please, the stage is yours. Thank you.
Hello, everybody. I hope you're all awake. I could see we were losing some of you. So I'm just going to ask, can you just stand up for a minute and ask your neighbor, are you present? Yes, great. Okay. We can all, oh gosh, okay, you're very excited about that, I can see. So thank you very much, everybody. We can all sit down again. So my name is Yvonne Palm. I'm the Chief Risk Officer at African Reinsurance Corporation. I'm also a board member for the Casualty Actuarial Society, where I unashamedly champion the African and emerging market agenda. I'm actually just your moderator for today because it's intended to be an interactive session, but we have our two speakers here. I know you're very sad you're not going to hear from me, but we have our two speakers here. Ndumiso Mavimbela, we practiced that, I don't know if I did it right, and Mike Tichareva, who are going to be taking you through their topics. I'm actually going to hand over to Ndumiso to go first. He's going to talk to you about expert opinion and litigation calculations, and he says that he is a damages actuary and also works in Social Security and retirement funds. So I'm sure we'll be hearing some interesting information from him. And then straight after him, we're going to go to Mike Tichareva, who, when I asked him what type of actuary he is, he said he works in everything. But we know that he's a pioneer in the banking industry. So I'm going to hand over to Ndumiso first, and straight after him, we're going to hear from Mike, and then afterwards, we're going to take questions and answers. So we're going to try and make it snappy. All right, thank you.
Good afternoon, and thanks, Yvonne. I'm not sure if okay, thanks. Okay, thanks, everyone. I think I'm going to go straight into the presentation due to time issues. We can just go straight into the next slide. Sorry. Okay, I think it's going to be a very short agenda. I'm just going to talk about the actuarial skill set, types of damages claims and other expert opinion cases. I'll look at selected case file, it's going to be one case. And then just to show that damages work is not purely actuarial. There's actually a lot more than actuarial that one needs to factor into it. When you can go to the next slide. I think from an actuarial point of view, I think the skills that are actually more, that then actually develops are ability to capitalize long-term contingency payouts. So this is generally for reserving purposes, for pricing, settlements, financials, and other types of liabilities. I'm not sure if you can move to the next slide. Looks like the slides are not moving. Otherwise, I will continue. Okay, and in terms of third party, in terms of the damages claims, so I've just separated them into two. The first part is third party injuries. So third party injuries are examples would be car accidents, train accidents, animal attacks like dogs. I mean, like in South Africa, dog insurance, it's a big thing, especially if you have bull terriers. Because I mean, they can easily sneak out of your yard and get somebody injured. So there are claims around that. I've also worked claims around the lion attacks. Actually, in that case, was quite interesting. A lion sneaked out of a private game reserve and somebody died, so it became a loss of support claim. There are medical negligence or malpractice claims. There are employment matters. There are also other incidents like police shooting. I mean, for example, in South Africa, I got involved in the Marikana claims as an actuary, where like miners were shot when they were on strike for salary improvements. But other than that, there are other claims, like your commercial claims. Sometimes there are disputes, company disputes, so you're looking at quantifying the claim, like your profits. There are divorce claims, where there are serious disputes in divorce. Divorce actually, they're very tricky, because there's a lot that you need to go through. For example, you will need to understand the type of marriage. Is it control of property? Is it out of control of property? Is it accrual? Is it out of accrual? And then once you look at the assets, you also need to look at the act. For example, in South Africa, you can exclude things like gifts. For example, if let's say your parents had gifted you a house, you can exclude that as part of the divorce. There are other issues like non-pecuniary claims. Say, for example, previously you had been injured and you got an award for damages, not the pecuniary one. Pecuniary one are the ones that you can quantify, like your loss of earnings or future medicals, but there are the non-pecuniary ones, like your disfigurement, the pain that you're suffering. So such type of claims in South Africa, you can actually remove them as part of the net assets for the purpose of a divorce settlement. But you also need to take into account about different legislation and how things are working. There are pension disputes. You also get involved quite a lot in estate claims and maintenance claims. So generally what happens on maintenance claims, if you've got a big estate, it gets taxed in South Africa. So one way that people try to avoid passing the money to the tax collector is to make the future support the wife will have received as a liability. Say for example, the net assets are 10 million rands. So then the wife, the spouse can claim that now my husband is dead, so I've lost support. So that needs to become a liability on the estate. So that can easily now reduce the estate to say a 3 million rands, in which case now the tax liability almost distinguishes. So in that way, like it extinguishes, and in that way you've saved, and also it's fair, because had the deceased not been dead, you would have been supported. I mean, there are also lots of rules about maintenance, about what can be included, what cannot. So it's also not just a purely actuarial calculation. But so I have to run quick. We can't do this in 15 minutes, so I'm trying my best. I mean, just on the guiding principles, the most important thing about damages claims is understanding the law of the land. Case law is very important. But also more important, understanding the hierarchy of court judgments. For example, in South Africa, if the Constitutional Court makes a ruling, it filters automatically to every court below it, because that's the highest court of the land. If a judgment takes place in a magistrate's court, if you are working on the High Court, you can actually ignore that judgment, but once it takes place in a province, it sort of applies to that province. If a judgment takes place in the Supreme Court, it applies across all. So that, you need to understand how the court system works, so that you make sure that your calculations are in line with the court of the land. Calculation should generally be best estimate. Actually, there's a good UK judgment. I think it's will versus will. There are also similar judgments in South Africa. When you do this calculation, you should be looking at best estimate. So you need to balance the risk of over-provision and also under-provision. The injured is generally considered to be risk-averse. So what that means, it means you cannot discount at a very high discount rate and claim, say for example, in South Africa, you cannot say decide to discount at 15% and claim, no, this person should be, the injured should be able to invest the money and replicate the payments at 15%. Because there's too much inherent risk in doing those calculations in that way. But what's also more important is that how the claimant uses the money is irrelevant. If, for example, a claimant if part of the claim, for example, it's a future knee replacement of 200,000 or 300,000, if that money is paid in today's money terms, the claimant doesn't need to do that knee replacement. What's important is to give them the money to do it, but not to force them to do it. So when you do those calculations, it's not really about if they're going to do it or not, but it's about what they need. Then what's also important, I will actually show the case leading to the next line. That it says that calculations that resonate the same to actually sort of produce the same outcome. So what the courts are looking for, they're looking for consistency, they're looking for predictability, they're looking for reliability. For example, you cannot have two cases exactly the same. In one, you decide, I'm going to discount it at 4%, the other one going to discount it 1% because I want this one to get a higher benefit than that one. So you need to produce that consistency, predictability, and reliability. Then when you go to court to testify, what the judges don't want is your assertion without proof. So you don't say like the claim is 100,000 rands, for example. The judges are not interested in what the final quantum is. They're interested in you leading them on how you get to the final quantum. So that's why I always say, like, it is not the conclusion that's important. It is the reasoning towards the conclusion that the judges are looking for. Just further on the guiding principle, what you're looking for is independence. That's very important because once you step in court, you are not representing your client. You are actually assisting the court to come to the right decision. So your obligation, it changes, even if before you go there, even when you testify, you take the oath, and the oath has nothing to do with your client. So that's why I always tell people, when you go to court, answer only what you're asked. Don't try to play advocate. You are not an advocate, you are an actuary. And also play within your expertise. If you're a general insurance actuary, don't go to court and testify on life assurance matters, because you will be nailed. Being an actuary doesn't mean that you can testify across all actuarial fields. You need to testify where you've got your expertise, where you've got your experience. There are professional guidance notes. The Actual Science Africa has got guidance notes about what's reasonable for you to consider yourself an expert. The UK has got some guidance notes. And also, don't selectively examine facts. When you are an actuary, you look at a report. Even if there are things you don't like about it, you still have to do it. It's just unfortunate. Your job is like I can always say you are a calculator, if I put it like that. You are not examining facts. You're not deciding who's right, who's wrong. That has got nothing to do with you. That's got everything to do with the legal parties. But what's more important is that judgments can actually be extended to your professional board. And it's unfortunate because, if you work in damages space, you work with lots of experts. Like I work with doctors, accountants, industrial psychologists, lawyers, advocates, and I have seen judgments being extended to the professional board. That because judges, they get so infuriated with people who do a report, they come to court and they talk something completely different. And when they get asked, why are you changing the tone, you can see that it was actually fraud. They were trying to see if they were taking chances. So judgments do get extended to a professional body, and unfortunately, if that gets happened, that's a disciplinary issue. And then the other important thing that if you're an expert, if you do damages work as an actuary, you also need to understand your position. Are you giving an expert opinion, or are you an expert advisor? If you're an expert advisor, you are advising your client. So that happens outside of court. You can never do that in court. Once you're in court, that's an expert opinion. If you're going to put a report into court, that's also an expert opinion. So an expert advisor, if you're talking to a client, like, yeah, I think you can try that, That's expert advisor. That's different from being expert, because once an expert opinion, you cannot be taken sides. You need to impartiality, you need everything. I mean, this is actually a very interesting case. Like it's a South African case where they say the method of actual creation is, where the method of actual creation is adopted, it does not mean that the trial judge is tied down by the actual calculations. He has a last discretion to what it was as right. And then this leads to what I said, Peter, actual calculations, it is not the numbers, it's actually how you guide the judge. Because judge, they use those numbers and then they depart from those numbers if they think maybe your reasoning needs to be tweaked there or needs to be tweaked somewhere else. I mean, this is also another interesting case, what I spoke earlier, South African case also. So this one, I'm just going to take one of the lines. It says, it is important that awards, where the sequel of an accident are substantially similar, should be consonant with one another across the land. Consistency, predictability, and rapidity are intrinsic to the rule of law. Apart from other consideration, this principle facilitates the settlement of disputes as to quantum. This is very critical, because what the courts are saying the case you're working on should not have an influence on how you do calculations. Like if you are defendant actuary, you should not behave different from if you are a plaintiff actuary. I mean, South Africa now, they also appoint you as a joint expert. Like I'm currently working on a big medical case now. I'm a joint expert. The two litigating parties have agreed that I do the work based on the reports and there'll be only one actuary in the case. But clients can only do that if they've both worked with you and they know that you are not a hired gun. So what courts in South Africa, they call experts to take such as hired guns. So, I mean, you can never be a hired gun in such cases. I mean, this also just to explain the whole issue about what it means to be in an expert business. So it says, no matter how skilled or eminent, you can give no more than evidence. So if you are an orthopedic surgeon, you don't talk about the brain. If you are an actuary, you don't talk about knee operations. You cannot say, no, I think that knee operation being that the cost of the future knee hip replacement I need to value should not, it's unnecessary. It's outside of your field. You just value it because the doctors have put in their reports. So you cannot go beyond what your expertise. Actually, this is a very interesting case, actually from the UK. So it's also quite an interesting case, like why are actuaries involved? There's a nice case in South Africa where the court says they do not deal with rats and mice. So what that means, it means don't bring to inside the court issues that can be solved outside of the court. So what that means, it means in South Africa, most of the judges insist on that you must prove that you have pre-trial meetings. So if you've got your case, your defendant actually does a report, plaintiff actually does a report, you look at the numbers, you get them to talk, they have to do joint, they need to do joint minutes, you only go to court only for the issues that cannot be resolved outside of court. Like don't clock the court register for useless, if I to use the word useless issues. I mean, also, there's another case where the judge have said that they prefer the one claim only because it's been supported by actual numbers. The other one is just a thumbsuck number. So there is a big reliance in South Africa in terms of actuarial being involved in assisting judges. I mean, in terms of the calculations, what really are you doing there? So the whole point about the calculations is just to bring the injured into the same position. So say, for example, someone, let's say it's a train accident. You're now injured, you've got future medical costs, you're unemployable. Obviously, from an employment point of view, you've lost because had the injury not taken place, you would have continued employment. Now you can't work. So you need to be compensated for loss of future earnings. Then maybe your injury means you need to have a knee replacement, maybe another one in 15 years' time, another one in 20 years' time. So all those are expenses that, had the incident in question not taken place, you will not have incurred. So we need to capitalize that. So there's a claim for loss of earnings, there's a claim for future medical costs. And then then they add what they call now the non-pecuniary claims. Now you may be wheelchair bound. Just for being in a wheelchair, I mean, you need to be compensated because you you could do things on your own before. So the loss is generally like your pre-incident possibility. What was your earning potential pre-incident? What is your earning potential post the incident? And then the loss just becomes the difference between the two. That's the pecuniary one. Whatever in doing those calculations, you need to allow for all the contingencies. For example, mortality. People can only earn if they're alive. So when you do those calculations, you need to allow that people are only earning only for the probability that they're alive. You need to allow for returns, because if you're capitalizing now, you need to allow that investment income is to reduce the claim for taxation. So you need to know, are claims taxable or not? If they're not taxable, it means in your calculation, you need to deduct notional tax, otherwise you'll be overcompensating the claimants. Also, you need to look at the relevant inflation, especially if you're doing things like medicals and loss of earnings. For example, medical inflation will generally be expected to be higher than, say, a salary inflation. So you'll find yourself that on the medical-related items, we've got a much lower net discount rate than on the salary-related items when you're doing the calculations. And then just the non-technical stuff, it is your case law, it's very important. You need the net discount rate. So in South Africa, the judges, it's a very advanced system there in terms of the settlement. So judges are not actually looking for the quantum of your discount rate or your inflation rate. They are looking for your net discount rate. They now know that claims are not driven by inflation being 6% assumption or 5% assumption. It's actually being driven by the net discount rate. So that's what they look for, which is quite interesting because they are thinking actuarially. And then you also need to check, are benefits capped? Because in some legislation, yes, you can claim, but the legislation puts certain caps. For example, in South Africa, the Road Accident Fund, it allows annual caps depending on when your incident took place. You also need to check, does this type of a claim imply compound interest or simply interest? And also, when can simply interest be changed so that you can now apply compound interest? There are lots of cases around these things. A big topic is also mortality curtailment, especially for serious injuries. What you generally find, especially like let's say a cerebral palsy case, it's probably well known that cerebral palsy children, they don't survive for long. So there you're looking at curtailed mortality, as opposed to say 80-year, say 70-year life expectancy. You're probably going to be looking at a 20-year life expectancy. So now the question is, should you value the pre-incident on the normal life expectancy, or should you value it on the curtailed life expectancy? Again, you look at the legislation applicable. In South Africa, you have to value the pre-incident on the curtailed life expectancy. The reason always brought forward by the courts is that if you were to pay the injured person on the normal life expectancy, you're actually overcompensating because the money will end up with the third party. But some legislation, they say, no, you cannot benefit the wrongdoer. Because if you do that, you're actually benefiting the wrongdoer in terms of the costing. Also, how do you treat past losses? Do you apply interest to them or not? What about apportionment of damages? Sometimes an incident does take place, but you find that the incident is probably 80% to blame to the injured, 20% blame to the other party. So all those things become quite important. And then there are also the issues of contingency fee arrangements. Some people get so injured that they cannot look after their financials. So when they get awarded, it means there must be a third party to look after the monies. And in South Africa, that is based on the capital lump sum. So it becomes it becomes very important that how do you set that correctly to ensure that the trust fees are not excessive? For example, what you also find, you find that attorneys, they go on contingency fee like a 25%, that if I win the claim, I get 25%. So what we've been doing for some of my clients is that, okay, that's fine, we get the lump sum, that's the judgment that has taken place, but we're not going to pay trust money on 25% because we know that money is going to the attorney. It does not need trust money. And also sometimes it's children, we're only going to pay the trust fee up to, say, in age 21. Then they can look after their monies after that age, especially if they're not seriously injured. I'm just going to run one example and then it will be done. So this is just an example just to show how case law can actually change their story. So in this case, we're looking at a loss of support where we've got a husband who's earning, say, 5,000 rands per month, and a wife who earns 25,000 rands a month. So you're looking at a total family income of 30,000. We assume there are going to be 2 minor children in the family. So in South Africa, the way loss of support generally work, an adult gets apportioned 2 parts income and a child gets apportioned 1 part. So in this case, we're going to have 6 parts because it's 2 for each adult and 1 for each child. So we've got 6 parts. So each part, it's 5,000. It's just the total divided by the number of parts. So with that logic, then it means the husband is benefiting 10,000 a month, the wife is benefiting 10,000 a month, and the first child 5,000, the second child is benefiting 5,000. So now let's just look what happens now if the husband were to die. So if the husband were to die, say he's negligently, someone is being sued, the only income left now in the family is 25,000 because the 5,000 from the husband has disappeared. But now instead of 6 parts, you are left with 4 parts. So each part is now worth 6,250. So again, using 2 parts to an adult and 2 parts and 1 part to a child, it means the wife is getting 12,500 and each child is getting 6,250. So if you go back to the previous slide, the wife was getting 10,000, but now the wife, because of death, is getting 12,500. The child was getting 5,000. Now the child now is getting 6,250. It means actually everybody's better off from the death. So it means the claim is 0. So even though the person who died was an earner, but the family is actually better off from the death. So if you were to put this in court in South Africa, the claim will actually be 0. But if you look at if now we change the story, we say, okay, let's just say the husband, instead of earning 5,000, was earning 20,000. So now we've got total income of 45,000. So now the wife pre-incident will get 15, the husband will get 15, each child will get 7.5. But after death, the wife will get 15 and each child will get 5,000. That makes the 25. Why does the wife get 15? Why is it not shared 2 parts post-incident? Because African laws say you first pay for your own loss before you can pay for somebody else's loss. Which means before the wife can use her income to support her children, she must first support herself to the level she was earning pre-incident. Which is why in this case, what you'll find that the wife will have a nil loss, but each child will have a loss at 2,500 per month. So this is just show you how case law actually affects these calculations. I mean, it's a very big field, but I mean, I'm finishing now. So I mean, just to conclude, it's just to show that, I mean, there's a lot. You need to understand your case law. You need to, professionalism, it's very important, especially since you take an oath when you go to court. There are lots of other issues. I mean, I've just selected random. That, for example, there are judgments around how do you choose the level of support for a disabled child versus a normal child, how to handle maintenance claim, curtailed mortality, who benefits, is it the wrongdoer or is it the injured? I mean, that alone can be a topic on its own. Then what is earnings? I mean, there have been judgments in South Africa about sympathetic earnings. For example, if somebody was working, then he gets injured, he can't work, but somebody now is feeling pity for him, let me just give you a job, I'll pay you so much. Is that earning, or is that somebody is that a salary, or is it somebody being sympathetic? In some cases, actually, the courts have ruled that you cannot consider that as a salary to reduce your claim because that's not employment. It's been someone being sympathetic to that party. The issues around the capital gains and future rent. But another issue, can you ignore case law? You can, if some judgments, I mean, are just wrong. I've done that and I've managed to defend that. You also need to use international case law where you can, when to fill gaps. I did it I use one UK law on how to transit. Because if you work on cerebral palsy cases, we rely on data from California. So I had to use one UK law to fill the gap and the transition to South Africa. How do social benefits happen? And also the issue of inheritance, especially on death. Because let's say, for example, you are a spouse, you are married, out of control of property. If you die, then your husband wills you the house. So now your wealth has moved from 0 to 10 million just because now you own a house. You do not have a house. Now the question now is, okay, is that inheritance, should that inheritance be used to offset your loss? Because now you are richer than before. You didn't own a house before. Now your husband has died, you now own a house. if it needs to reduce the loss, how does it reduce it? Is it the full 10 million rent house that is going to reduce your loss, or is it the expectation of actual inheritance? So in South Africa, what you do is you call it acceleration of benefits. So it's the difference between what you actually inherit versus the expectation of inheritance that followed the normal life tables. So it's a sort of a quite complex calculation that you need to do that, and then you can use that to reduce the loss. I'm concluding, it's a beautiful field. You work with many experts, your medical experts, accident experts, accountants, lawyers, advocates, judges. When you go to these meetings, you sit in a big round table, find sometimes there are 20 of you, everybody, especially if you're strategizing for a case. So, but what's more important for me is that people need to understand that from an actual point of view, there are no winners or losers in court. That's for lawyers. For actuaries, we are calculators. I will end it here, but yeah, it takes more than this.
Right, I'm just being told that I've donated my time. I've got less time that I'm supposed to have, which means we probably do not need slides. So I'm just going to talk. You can put up slide, maybe the last, I think the second from last, that shows the banking subject, and just leave it like that. So this topic is about emerging areas of actuarial practice. Some of you, depending on which jurisdiction you are in, you would call them wider fields. But I'm going to talk about banking. And from a South African perspective, we no longer consider banking as wider fields. It's actually now a core area of practice. And it was intentional, deliberate, that we came up with, that we considered banking as a practice area. So many years back, I think 2009, 2010, we realized that there are many actuaries that were already working in banking. So we set out to look at the various areas where they were working, and that required us to understand a bank, the risks in a bank. So you see that the slides talk of the risks in a bank and how a bank actually operates. And we went on to formulate a banking committee after realizing that there were actually about 300 actuaries already working in the banking space, but the profession not serving them. And we went on to launch a banking subject in 2015. So I was part of that whole process. And we were saying we need to create a sustainable profession going forward. So what do we need to do? We need to find new areas of work for actuaries. And banking came in naturally. So what's in a bank? I remember having a debate with some senior actuaries, life actuaries, saying there are no liabilities in a bank. But I worked in a bank, so I said, what authority do you have to say there are no liabilities in a bank? It's just that you do not understand it. So a bank has got liabilities, and the liabilities of a bank are the deposits, the customer deposits, the money you put into the bank, it's a liability for the bank. The capital a bank raises in the market to lend money out is a liability, and so forth. Then the assets of a bank are the loans. So the loans are the assets of a bank. So those are the two sides of a balance sheet of a bank. So there is actually a asset liability modeling that happens. There are many risks. We normally talk of a banking book and a trading book. Trading is where banks go in the market, they trade in derivatives and all other things. The banking book is the loans that are actually given by a bank. Now, there are risks in there, and you actuaries deal with risk. So you have got credit risk, which is a major risk. Under that, I'll just give an example. Those of you who know International Financial Standard Reporting number 9, which requires you to calculate expected credit loss. If you go to expected credit loss, try and decompose what it is. It's really probability of default multiplied by exposure default multiplied by loss given default. If you look and try to compare with the insurance where you practice, You'll find that exposure at default is similar to sum assured. You'll find that probability of default is similar to the probability of a claim. So naturally, actuaries have got that expertise already. It's something you have been trained already. So I'm just using this as an example, right? That credit risk, under credit risk, you've got expected credit loss, but there are a whole lot of other things as well. Like in retail banking, you've got credit scorecards. When you bring a client on the book, you have to score and understand their likelihood of being able to pay and all sorts of things that happen. Beyond that, you've got other risks as well within the banking space, such as, so you still have market risk, you still have your operational risk, but there are additional risks such as liquidity risk that are actually much more important for a bank than an insurance company. So you hear a bank going down, they use the term a run on the bank, where everybody who has put a deposit in a bank, they hear that the bank has got issues and then they want their money. So liquidity risk is actually a very big issue within the bank. Then you've got issues of capital management. These areas, I'm just mentioning them so that you can see the different areas where actuaries can be involved in a bank. Now, if you look at this slide talks of the banking subject. All we did is we said, what are the areas in a bank? Therefore, what should we be teaching actuaries? That's all we did. So you see that there is the principles subject, and then there is the application subject. Those of you still writing exams, that's at fellowship level where you've got the principles and then the applications. The principles we are covering mainly, so what is the bank, the overview, regulations, and all sorts of things, and the measurement of risk. So how do you measure risk? For example, market risk, use value at risk techniques and the like. Then the advance, we are now dealing more with management, which is managing the risks as opposed to measurement. So this subject is there. When we started recognizing banking as a practice area in 2010, one thing we set out to do was to say we need to then educate actuaries, because there was no one teaching you. You just walk into a bank and you figure it out on your own. So we then had to launch a banking subject. So this is the story about banking. We have gone around the world now, North America, in Asia, here at home in Africa, in Europe, talking about this. In 2022, Actuarial Society of South Africa has launched this international, it's an international subject, together with IFOA. So we started the subject in 2015, so we were already offering it as ASA. But in 2022, we revised the whole subject together with the Institute and Faculty of Actuaries, and then we relaunched the subject. So you can now take this subject through the Institute and Faculty of Actuaries, but you can also take it through the Actuarial Society of South Africa, because we actually have the international version. It's the same paper, so you can also take this subject. So essentially, we thought about sustainability of the profession to come up with this. So he was talking about damages. These are new areas. In South Africa, it's no longer a new area. It's actually something that is normal. So you as actuaries, please continue thinking about new areas where you can be involved. Climate change is a very good example where you can actually get involved in climate change. Even if you're in a bank, you can say, how do I take into account climate risks in doing the work I'm doing in the bank, in setting the capital that I need to set? So many. I can spend 10 hours talking on this topic, but because we don't have time, I am going to allow you to come back to the stage. Thank you very much.
Hello? Yeah. Mine is.
Okay. And yours? Sorry.
Hello? Yeah.
Mike, is yours live?
I think Can you hear me?
Okay. All right. We're good. Okay. So thank you very much, both of you, for your talks. We're going to open it up to questions now. And as Mike kindly sort of wrapped up for us, this is about emerging or non-traditional actuarial fields. So feel free to ask them either about their respective fields or about, something else. Maybe you're thinking about branching out or something and you have a question for them. So we'll take questions. Are there any questions from the audience? Okay, we have one over here. Anyone else, so we can just line you up? Okay, we have, the second one will be over there at the back, and the third one is there. Oops, sorry.
Hello. Thank you very much, Mike. I know in the banking space, right, there is this Basel 1, Basel 2, and 3, where you can study and then help the banks to measure their risks. With actuarial space and what you are discussing in terms of the program you are developing in South Africa, which of the regulations do you use? The banks, I know they use Basel 1, 2, and 3. But with the actuaries, which of the regulations do you use?
Okay.
Thank you.
Should I just go? So, look, the banking regulations in terms of Basel did move in succession. So you had your Basel 1, it was succeeded by Basel 2, and then Basel 3 was more beefing up Basel 2, really. So if you look at, in terms of studying, these are international regulations. They are applicable in almost every country in the world. We include a timeline and history of Basel up to the Basel 3. And as an actuary, you need to know where Basel 1 failed and what then came as Basel 2, which is, we're talking about risk-based capital earlier, right? Similar to Solvency 2. And then what else was included in Basel 3? Issues of liquidity, capital buffers, and the like. So everything is covered. Thank you.
Okay, the next question's over there at the back.
Hello. Good afternoon. My name is Kyle Rudden, Caribbean Actuarial Association. Thank you, gentlemen. Excellent presentations. My question is for Ndumiso. In England and in the developed countries, they often use actuarially generated tables, like the Ogden tables, to assist with benefit claims. I have often thought that us doing things for our countries would be a good idea. And I wanted to know if you had any thoughts on that.
Thanks for the question. Yeah, I am aware that I know like the UK uses the Ogden, I think it's the Ogden tables. So in South Africa, that's why I was saying mortality on its own, it's a topic for the future. Because South Africa, they've got some very serious judgments that have shaped mortality in damages space. For example, one of the things you cannot do, you cannot select a mortality table based on race or socio-economic status. And that's a constitutional court judgment, which means it's applicable across the land. So as actuaries in South Africa, we do have a damages and compensation practice area. We sit there, we revise all, we debate judgments. We do think that, okay. Yeah, we do discussions around the Ogden rates. We have given thoughts about those items, but unfortunately, it is very important that you make them applicable. Otherwise, you will be overcompensation, especially in South Africa versus UK. We are probably more likely to end up compensation if we had to go the UK route of Ogden tables.
Okay, thank you. I think we'll have time for a few more questions. So are there more people? Okay, so can we have a mic go down over there as well? And anyone else? Okay, there's a mic there already. So we'll start with Wise.
Hello. My question is to Mike regarding the banking qualification. I'm just curious to know, within the banks, there's always been a banking track, which is much shorter. You get out of school and you go straight to the bank, or you become a chartered accountant and you go to the bank. The actuarial qualification takes quite a few years to get to qualification. How have you found the uptake in this particular program, and what is the general feedback around qualifying as an actuary within the banking track, and then applying those skills given just the level of appreciation actuaries might have in a typical traditional bank.
Okay. Thank you. What's happening? Can you hear me? I can shout because my voice.
Yeah, we can hear you.
Okay. Look, what happened with banking is very interesting. Actuaries started working in banking before introducing the subject. And it was in two main jurisdictions, South Africa and Australia, right? So Australia has got more than 500 actuaries working in banking, actuarial professionals. South Africa also has more than 500 working there. Now, when you then ask the uptake, the reason we ended up coming with it is because we said we actually need to add more because people were already in there. So compared to pensions, I'll always use pensions because pensions, a lot of changes or things that need to be done to improve our continued involvement in pensions. But if you compare in South Africa, you find that the pensions fellowship subject is taken by 2 or 3 people, and banking, you will have 15 candidates taking that subject. So we have got a number of actuaries we have qualified through the banking track, and we continue to have a lot more. So the uptake has been very good. We do not want the risk of people going into a bank and finding out what to do on their own. And then we say, let's train them. But the uptake, as you asked, is very good. I mean, compared to other areas, it's now comparable maybe with the healthcare subject, somewhere there. Yeah, so it has been very good. And
okay, thank you. Our next question will go, yeah, John.
Good afternoon, John Robinson from the Society of Actuaries. Question for Dumiso. You were mentioning as you went through your progress the certain principles and things that you are required to observe. And so my question for you is whether those principles are codified in an actuarial standard of practice of some sort. And if the answer to that is yes, maybe you would share with the audience what these actuarial standards of practice are all about.
Thanks, John. Yeah, there are, I think South Africa, I just forgot, but I know it's one of the APNs, because I sit in the Demis Committee, I know we've got the standard, so it gives a guidance, when can you, for example, it guides you what expense you need to co-sign, to sign off as an expense actuary. It also goes to the extent that it's not just a damages actuary, it's also specific fields. For example, an accident report is different from a medical report. So it doesn't make you a damages actuary overall, but it wants you to gain the specific experience for that field. The UK also got a guidance note, I just forget the number, but I know the IF also got its own guidance note about being an actuary as an expert witness.
Okay, thank you. And then we have a question. I think that's Jesse, I can see.
All right, my name is Kofi Efri-Nyamiche, University of Professional Studies. I'd like to ask 2 questions. The one who spoke about the banking, if you talk about risk measures, and usually we have the expected shortfall and then the value at risk. I want you to help us, practically speaking, how you could use this in an insurance company or in the bank itself. That if you are able to calculate the expected shortfall, if you're able to calculate the value at risk, if you could help us, practically speaking, how you use this in the insurance companies and the banking sector. And number 2, we also learned about the capital adequacy ratio, or yes, and I also have read from somewhere that if you are able to calculate your value at risk, that could also help you find the capital adequacy. I want you to throw much light on that for me. Thank you.
Can you help me, Yvonne? Can you repeat the question so that I don't get lost?
Okay, the first one, a practical exposure to the value at risk and expected shortfall in the banking sector or in the insurance sector. How can you practically use the value at risk and expected shortfall?
So you're asking me to
yes,
go through a calculation. That's a difficult question.
No, not that. After you have calculated, you've calculated value at risk.
Yeah.
So what? What does it mean in an insurance company?
So essentially what you're doing, I'm going to, the example I think I need to use is the one for capital, right? Even in insurance company. Why do you hold capital? You hold capital because you want to cover yourself against the risks that you're bringing onto the balance sheet. So what is it that you use to calculate capital? You can use a value at risk technique if you are, say, calculating, if you are measuring market risk, okay? So that you can quantify that capital. So the question to ask is, how do you quantify the capital? So you quantify the capital by using all these different techniques that you want me to go through. That's how really it is, whether in banking or in an insurance company. But in a bank, that's exactly what we do. Does that answer your question?
Somehow. Yeah.
Yeah, because to be honest, I'm not able to be like a German actuary who put up a very big equation and all sorts of things. But I'm just saying, just think about what you're trying to do. You're trying to quantify your risk. And then you are using all these different techniques. I just gave an example of value at risk when I was talking. But that's essentially what you're trying to do. You hold capital against the risk you're taking.
Okay.
And then you have to quantify it.
If I might throw much, with the value at risk, let's say you have a face value, an amount of money. You want to know how much, if let's say you have a loss, definitely you have a loss, and then how much you can still be able to remain in business. But I wanted to know, let's say you have somebody doing these calculations, all right? Then I just wanted to know how practically some of these things have been. I thought maybe some of us might have an idea to how they have been using the value at risk and expected shortfall, perhaps. I know, yes, to help you get your capital, but let's say after you have calculated and you have a face value, and then you want to know how you can still remain in business for a given alpha or loss. So I just wanted a practical exposure to that.
Okay, so let me give you something that's close, that's already happening. IFRS 9, okay? So you are asking how it's then used in practice. IFRS 9, the IFRS 9 number appears in the published accounts for a listed bank, for a listed company. So you actually go and calculate the expected credit loss, the losses that you expect to incur. When you now have that number, some banks go further and say, maybe we've got models that we're not trusting yet. Let's also have overlays. So they go and debate that number and maybe increase it or whatever the case might be. That is the number you then find in the financial statement. So I thought you were asking about what then do you do in practice with whatever number you'd have calculated. So that's an example I can give you on IFRS 9. It then appears in the published accounts. If it's capital, you will find that you want to make sure that the capital you're holding is above the minimum capital requirement. So you do the same thing. So those numbers are then used to estimate the amount of capital a bank needs to hold. I'm not sure if I have answered you, but in practice, it actually happens in practice. I actually quantify these numbers. They appear in published accounts because you would have done the calculation.
Yes, I think, I think you have addressed the question. And also just to wrap it up and sum it up, tying it up with capital and risk management, value at risk is you're really looking at the tail end of your distribution and trying to see, to what extent you can weather events that will reoccur at a certain amount, with the events that recur at 1 in 100 years or 1 in 250 years or something like that. So you're trying to make sure that you're holding enough money to cover that. So that's what you're using value at risk for. So it's up to the company to actually decide which level of confidence, if they're not in a regulated environment that actually tells you what to use, but it's up to the company to decide what level of confidence or how comfortable they are, where they should be, and then once they calculate that value, that's what they use. Yeah, so I think we are, we're going to be eaten alive by the timekeepers here. So I think we have to wrap up now. So thank you, everybody. Thank you, Mike and Ndumiso, for your contributions.
Thank you, Yvonne and team. Before we take the next presentation, please one very important announcement. All those billed for presentations tomorrow should please make an effort to submit their presentation slides to the technical team at the back row of the hall before leaving. Our next presentation is on IFRS 17, Beyond Implementation, and this will be delivered by Nick Hill Dodia from Zamara Actuaries and Consultants. Let's welcome him, please.
I guess while we wait, I'll just give you guys a promise that I won't be talking about anything technical on IFRS 17. I'm sure you all saw the name on my presentation and thought, oh my goodness, not another IFRS 17 presentation. So actually what I want to do is I want to take you through sort of the impacts of IFRS 17 that we've seen on companies and sort of how that impacts companies going forward. What the challenges have been for companies, especially across the African continent, in applying IFRS 17, and then moving on from that, just sort of looking at what next after IFRS 17. What should companies be looking for post-implementation, given that 1/1/23 is just around the corner? So probably if we go to the next slide, or next two slides. Next one. So I'll skip this as well. I guess everyone over here already has an overview of IFRS 17, sort of coming in 1/1/23 and the changes that it brings. But if we go on to the next slide, I think I've got a small poll question just to see or gauge the room, sort of, which of the following areas do you expect IFRS 17 to impact either your clients or yourself the most? So you can just raise hands. How many of you think it's sort of strategy? None? Performance measurement? None? Financial results? I think everyone's sleeping. Disclosures? Yep. Systems and processes? Okay, that's quite interesting. So we go to the next slide. I will take you through some of the areas that IFRS 17 is going to impact. So we look at it sort of impacting sort of your volatility in financial results, your operational performance and management, your business decisions, your presentation and disclosures, obviously, your systems and processes, and capital management and dividends, right? And what I just want to highlight here is actually at the center of all these things is actually your strategy, right? Your strategy is sort of at the core of your business. And some of the questions that we need to start asking ourselves is sort of post the implementation, how are we going to measure performance? Because we know, of course, there's key KPIs that are changing. So, the way we used to value our business changes quite significantly. And, on top of that is how should my strategy change going forward? So if we go to the next slide, I have two more poll questions. So, just to see how far people are along the journey. I'm pretty sure I know the answer to this. So how many of you have not yet started or have clients that haven't started an IFRS 17 implementation journey? Oh, the rest of you must be from a very developed market. Wow. How many of you have clients or yourselves have commenced your gap assessment, impact assessment? Completed your gap assessment and impact assessment? Okay, that's for a good number. And how many of you have sort of commenced your implementation? So now looking post the financial impact assessment and looking to get your solution. Okay, great. So it seems like a lot of the room is actually in sort of the CD area compared to sort of East Africa, which is in sort of the AB area. So we have quite different markets, as you can see. If we move on to the next slide, we're going to see like sort of what are some of the key challenges you found sort of in implementing IFRS 17. So how many of you found that one of the key issues is sort of getting your clients to understand the standard or getting internal management to understand the standard? Data availability, actuarial modeling, Now that's actually quite a funny one, which I'll come to in the next slide. And how many think of you have been struggling with reinsurance? So if we look at some of these challenges and lessons learned, so as we can see, like staff knowledge is one of the issues. Is sort of how have we been able to upskill some senior management team, or even just our core management team in understanding the standard. We found in most companies that we're working with, it's just the actuaries kind of who are driving this, and if not, if the finance function is given sort of the lead on this job, you find it that the finance function is trying to throw this back to the actuaries. I had one client, funny enough, who sort of, the CFO said he was hoping that he wouldn't find IFRS 17 before he retired, and now has been forced to learn the standard. Stakeholder management kind of ties into staff knowledge. So, we found one of the issues is, managing our senior stakeholders, because of their lack of understanding of IFRS 17, it's very hard to get a budget allocated to the implementation program. We found that, in cases where people have gone to the board of directors or to their shareholders asking for a big lump sum, give me $500,000 to implement IFRS 17, the first answer is no, because no one really understands the impacts of it. And we find that, stakeholder management is something that's really key. Availability of data is also something, I think, in our region has been something that really insurers struggle with. A good example is there's one insurer I worked with in Ethiopia to early adopt IFRS 17, but they actually didn't have any data for their life book from 2016 and prior, just because it all used to be manual. And they moved to an admin system in 2016, and that's only where you can get data from. And even with that one insurance company, if you look at the data that they're holding, the poor policy data that they hold, and you compare it to the data that they book their management accounts with, there's a big differential between the two sets of data. And it's how can you sort of manage IFRS 17 with such uncredible data, and then that follows on with that lack of experience data. And it's a joke I used to have when I used to work in the UK, was after finishing this job, is that IFRS 17 is sort of like a standard that was built for the first world, and they didn't sort of consider the third world. And that ties off onto sort of the third and fourth bits there, cash flow models and sort of archaic capital requirements. A lot of countries in Africa just don't have actuaries. If you look at it, South Africa probably has 1,000 plus people working in the profession. If you come to Kenya, we're probably second in line after that with about 70 qualified actuaries. And then we move on to Nigeria with about 40 or 50 qualified actuaries. And then sort of surrounding that area is basically nothing. A good example is sort of Ethiopia moved into IFRS reporting with not a single actuary within the country, but the regulator still expects them to sort of implement IFRS 17 come 1/1/23. And I guess also sort of in terms of archaic capital requirements, we are moving into risk-based capital, but that's only sort of coming in now. I think in one of the presentations we saw, like Kenya has been operating risk-based capital for quite a while. We've seen Ghana has now moved to a new capital requirement of 50 million CD. Uganda moved to a new risk-based capital requirement from year-end 2021. And we see Tanzania moving to that in year-end 2022. But a lot of other jurisdictions across the continent don't really have a risk-based capital approach. And that makes it a lot difficult for insurers to leverage off maybe that to come up with a risk adjustment as well. So you can see some of these are some of the difficulties that are sort of happening in our continent, and a lot of people will be looking just to implement IFRS 17 just as sort of a checkbox exercise. And one of the items, is the reason they're doing that is also because one thing we tell our clients is, for some companies, we work in such a competitive industry that if they don't implement IFRS 17 and some of the other companies working in their jurisdiction do implement IFRS 17, you find that the reinsurance rates that the companies who have implemented IFRS 17 are likely to be more competitive than the companies that haven't. And now the companies that haven't implemented IFRS 17, who maybe process or proceed with qualified accounts, now struggle to play in an ever more competitive business. So if we go to the next slide, I think I have one more poll question in terms of sort of what next in IFRS 17. So, what do you all think that you should be thinking about post-implementation? How many of you think it's data systems and processes? How many of you think about it's like your data quality and analytics? Strategy? It's my favorite word, as you can see. And, I guess all of the above, right? Yeah. So if we go on to the next slide, I'll talk about a little bit about sort of data system processes, a broader strategy, how you can use IFRS 17 numbers to tell a story, and then sort of how you can also look forward for better planning. So when we look at data systems and processes, so IFRS 17 has brought in sort of new data requirements, which has led companies to start thinking about, your new data management strategies, looking at access to data, the kind of data that you hold, integration of that data with other systems, the quality of that data. And then on top of that, we're seeing a lot of data protection acts coming around now within the continent. A couple of countries have already implemented it. Kenya is implementing, like, for example, their Data Protection Act from, I think it's mid-July this year. And you can see that brings on some more onus to companies to think about, data privacy as well, and that data access and integration. We also look at sort of, having a centralized data warehouse, whilst, a lot of the target operating models you look at on IFRS 17 will show you sort of that you should have a centralized data warehouse that feeds in data from your admin system, your actuarial cash flows, etc., that then feed into your sub-ledger solution. Like I said, there's not that many qualified actuaries or companies that are competent enough to run a solution themselves. So a lot of people probably will implement a managed service where they would take the sort of expertise of consultants to help them generate their IFRS 17 numbers. And such companies don't have centralized data warehouses. But it's something to think about going forward, not just for your IFRS 17 journey, but things that you want to do in terms of data analytics become a lot easier when you have like one centralized database where you can have sort of one single source of the truth. When we look at sort of IFRS 17 as a catalyst for broader strategy, I did already touch upon sort of the reinsurance side of things, and people need to start thinking about probably reinsurance and how they can optimize their reinsurance going forward. We know IFRS 17 kind of does bring a mismatch for some companies when they look at their reinsurance portfolio versus the contracts underlying that, and possibly maybe that's a strategy that needs to change for them. Another area to think about, probably not related to IFRS 17, is a lot of us have got comfortable with our reinsurance arrangements at the moment, and some people need to look at optimizing that strategy because you find that at times you're either over-reinsured or under-reinsured. It's just that's something you've never realized because, you just renew your reinsurance year on year without actually comparing it to sort of your risk appetite. How do we optimize capital? Like we've talked about, there's risk-based capital coming in. IFRS 17 is quite penal, I guess, on loss-making products, especially for the life insurers. So it's also looking at sort of, that low-margin business that we're writing. Is it still worth writing that low-margin business, or do we need to start thinking of other avenues of revenue? Which then ties to the next bit on product development, is also now looking at, how can I develop my products to be more in line with my new reporting requirements, with my new KPIs, for example. Things like VNB and IRR probably might go away, with companies now looking to target maybe a target CSM for products or for new business. When we look at sort of if we go back one slide. The numbers telling the story, your CSM has brought in like additional data layers. So you can do a lot more analysis on your profit. Your analysis of change can be a lot more deeper at a product level and at a cohort level. And with that as well, you can also start looking at sort of the drivers of profit. And then following that, you can also, I guess for clients who do have a more robust IFRS 17 solution, you can look at sort of using that for future planning and sort of roll forwarding your current positions and layering on new business, and then adding sort of stress and scenario testing on top of that to just see how your portfolios change over time. If we go on to the next slide, sort of the other areas to look at, which are, I guess now, some of the buzzwords, is sort of race for talent. We look at sort of redefining the future of work. Some of your key roles within the organization are changing because of the introduction of AI and tech. So it's very key to see how those roles will be changing and how KPIs for those roles need to change, as well as looking at probably how remuneration structures need to be changed or how those roles need to be redefined. Another area you need to look at is sort of upskilling your workforce for the new world. So this is looking at starting at sort of from the board level all the way to your sort of frontline staff, is sort of looking at, everyone needs to have that basic understanding of the digital blocks so that, we can move forward to a digital economy. Lastly, sort of like taking advantage of the gig economy, and that's, I think COVID-19 has all shown a lot of African companies that, you don't always have to be in the office to work, and you can also be sort of remotely working, and that does allow people to access better resources, working in different jurisdictions, just to better yourself, and it's sort of being more open about that. When we look at digital transformation, we have sort of a rise in insurtech that has been coming out. I think you see like a lot of the big insurers are either coming up with some of their own sort of digital products or buying out insurtech firms. I think one of the recent ones was Santam completing its sort of acquisition of, I think it's Joshua. They finished the day before yesterday. But the issue with InsurTech is it hasn't grown as fast as you think it would have grown, and I think in the African continent it hasn't grown as fast as it has in, say, for example, the European market or the US market, and that's probably just comes from a sort of trust deficit between customer and insurer. And if we look at it, we look at sort of, at point of claim, that's really when a customer really comes to appreciate the insurer that they're with. If that claim is paid out, you feel good, you feel great. If that claim isn't paid out, that's when that distrust now starts coming in through with the insurer, sorry. And that's one of the things companies do need to think about going forward is, millennials these days are more looking at service that is being provided, and, they expect sort of like a one-stop experience. So it's sort of, can I get onto an app, submit a claim, and, have that process like almost immediately in real time? And that's what companies need to start thinking about. But, and that's why I say, like, sort of InsurTech isn't really the silver bullet, but you also need to be like a bit more customer focused or customer centric. When we look at organizational silos, we're talking about, IFRS 17 did bring in a need for more collaboration across the organizations. You find that it's a multifaceted approach which requires interaction from different bits of the business, and hopefully that then does bring in a more collaborative approach between people, which ties on to my next point, which goes into enterprise view. So, having a more collaborative effort also gives you a more enterprise view. You're able to understand more what other bits of the organization are doing more thoroughly. I think for actuaries already that's something that isn't such a problem in our continent, because you find in most companies, if there's something difficult, it probably doesn't fall under our remit to look at it, but most companies will just throw it at the actuary and say, you can probably look at this. And having that enterprise view also then helps organization build their next generation of leaders, because you're now creating a group of people within the organization who understand the organization a lot better and where the organization needs to be going in the future. And then finally, sort of ESG. I think if I didn't mention ESG, none of you would have taken me seriously. So of course, that's something everyone needs to sort of think about going forward. Elevating the understanding of ESG is sort of, starting from your top management to middle management, making sure everyone has a clear understanding of what ESG means and what it means to the company and how it fits within the company strategy. And that's why we say sort of, ESG needs to now be embedded within the company strategy. But if the top management don't have a full understanding or appreciation of the benefits that ESG brings, that program wouldn't be a successful program. And then finally, when we look at social responsibility, it's sort of, some companies now need to be a bit more bolder in the S when we look at the ESG. So it's, taking a strong stance on specific issues like corruption, etc. And having that voice reasoned out and, having that strong stance, because I think that's what customers expect now from companies going forward. Yeah, thank you. Any questions? One there at the back. One here in the front.
Hi. Hey, thank you for your presentation. I enjoyed it. It's been a while since I left the insurance industry, so tell me if this is out of place. So the erstwhile Defense Secretary General of United States, Donald Rumsfeld, once coined a risks term called unknown unknowns. I want to know how IFRS contemplate unknown unknowns.
I don't think I have the answer to that one. Or maybe you can do, what do you mean by unknown unknowns?
I was hoping you would tell me that.
Probably, I guess, unknown unknowns, maybe you're looking at things that you can't foresee, which is sort of, I guess, which turns to the gentleman at the back who was talking about value at risk. In under IFRS 17, you have sort of a risk adjustment. So, IFRS 17 requires you to hold your best estimate liability, which is supposed to be sort of your, it's like 50% of the time you probably get that estimate right, the other 50% of the time you get it wrong. And you hold on to the risk adjustment on top of that, which is supposed to be sort of your added layer of buffer for that unknown unknown where your experience sort of deviates from what you expected. I hope that answers it.
Okay. Thank you. Maybe it's an unexplored territory, and I think actuaries can offer a lot of perspective there if it's not unexplored. But thank you for your answer.
Hi, Nikhil. Thank you for that. Name is Mlenga from the Actuarial Society of Zambia. I've got a question regarding reinsurance. So you mentioned it would be possible for companies that have implemented IFRS 17 to get more favorable reinsurance rates than others that haven't. What's the driving factor behind this, given the fundamentals most likely would remain the same?
So the fundamentals will be essentially, if we have two companies, Company A and Company B, both operating in the same jurisdiction that are both applying IFRS reporting at a country level, if you think about it, when your auditor comes in to audit your books, Company A has implemented IFRS 17, Company B has not. Of course, Company A will, depending on how the company runs, etc., gets their sort of sign-off on the audit. Company B, on the other hand, gets qualified accounts. So I believe when the reinsurers start looking at your accounts, you're looking at two companies, similar size, one with audited accounts and one with qualified accounts. So you can assume that the risk in the Company B with qualified accounts is much higher than the Company A who have sort of IFRS compliant accounts. Thank you.
Thanks, Nikhil. It's been a long day, and thankfully we've navigated to arrive at the last topic for the day, and the presentations will be delivered in succession by three professionals who have 5 minutes each to do this. So the presenters are Wilfred Kuton, ASA Benin. Are you here, please? Yeah, please welcome him. Mohamed Gabri, Tunis Re. And Redwan Rufai, University of Ghana. Okay, so I think Redwan is not here, so please, you have 5 minutes each to do this.
Hello, everybody. My presentation is in English, in French. I'm Wilfred Couton. I'm come from Benin. Then I will present today a management of discount on the death insurance contract in life insurance. Donc je vous présente aujourd'hui je fais ma présentation sur le management des remises sur les contrats de prévoyance en assurance vie. Ok, thank you. Merci. Alors, c'est bon, je peux aller. Ok, ok. C'est bon, ça peut aller. Ok. Ok, il n'y a pas de problème. Ok. Bonjour tout le monde. Ma présentation porte sur le management des risques, sur les contrats de prévoyance décès en assurance vie. Je m'appelle Wilfried Couton, consultant à Asda Bénin, ancien responsable technique à Atlantique Assurance Bénin Vie. Alors, pour introduire, nous devons remarquer que nos marchés assurantiels sont fortement concurrentiels. Et généralement, les primes d'assurance connaissent beaucoup de rabais. Alors, pour illustrer, nous prenons un risque d'1 million. Un assureur propose 10 000 francs pour assurer ce risque. Au même moment, dans les mêmes conditions, un autre propose 5 000 pour assurer le même risque et prie Dieu pour protéger son client pour qu'il vive jusqu'à la fin du contrat. Alors, qu'est-ce qui se passe? Nous devons comprendre dans ce sens que devant la concurrence, les assureurs font tout ce qu'ils peuvent faire pour quand même avoir le marché sans fortement considérer les impacts futurs qui peuvent résulter de ces comportements concurrentiels que nous avions sur le marché. Il est à noter que la mauvaise estimation du niveau de remise accordé aux clients impacte directement le rendement de ces produits d'essai que nous commercialisons. Et pour faire ce genre d'opération de remise, de rabais, l'assureur se base généralement sur l'historique de l'assuré afin d'appliquer des abattements qu'il détermine par l'expérience des années en tablant sur le volume d'affaires à réaliser. Donc, dans cette dissertation, pour répondre à cette épineuse question, nous proposons un modèle permettant l'estimation du maximum possible de remise qu'on peut faire à un client sur un contrat d'assurance vie décès en s'appuyant sur quelques déterminants comme la santé de l'assuré et aussi en introduisant un outil quantifiant le risque que l'erreur que nous commettons par unité de prime émise. Alors, le calcul de cet indicateur qu'on appelle le RUCA, que j'ai appelé le RUCA ici, est rendu facile par l'introduction et l'évaluation du second moment du risque d'essai en introduisant un nouveau commutateur que j'appelle ici le commutateur triangulaire W. Alors, quelques rappels. Le calcul de la prime pure en assurance vie d'essai, le temporaire d'essai se calcule par la formule 1 que nous avions là. Et la prime unique inventaire s'obtient par la formule 2 et la prime unique commerciale par la formule 3. Et le 4 nous donne la prime émise qui comporte non seulement la prime unique commerciale adéquate, le taux de surprime liant à la santé de l'assuré et aussi le taux de remise, et à laquelle nous ajoutons, à tous ces éléments, nous ajoutons l'accessoire. Alors, nous introduisons pour évaluer le moment d'ordre 2 le commutateur triangulaire W après avoir évalué le second moment qui s'obtient par la formule 5. Donc la formule 5 nous permet d'obtenir le second moment. Oui, avec la formule 5, nous obtenons le second moment du risque d'essai. Et grâce au commutateur W et T, nous facilitons le calcul de ce second moment sur la table d'essai. Donc, avec n'importe quelle table, grâce à ce commutateur, à ces deux commutateurs, nous pouvons faire facilement le calcul du moment d'ordre 2 du risque d'essai en temporaire, pour l'évaluation des contrats d'assurance temporaire d'essai. Alors, le risque, l'erreur commise par unité de prime commerciale se calcule par la formule close qui est le RUPCA, et qui n'est rien d'autre que qui s'apparente au coefficient de variance. Et là, nous le plotons de l'autre côté. Et qu'est-ce qu'il faut constater? Plus la durée de couverture du contrat est importante, plus l'erreur commise par unité de prime émise décroît. Donc, en résumé, nous pouvions dire que à travers ces observations, que les primes sont mieux quantifiées pour les couvertures de longue durée sur la table CIMA et pour les assurés de plus en plus âgés. Donc, plus l'assuré est âgé, plus la prime est mieux quantifiée avec la table CIMA que nous utilisons actuellement, ou lorsque les contrats sont de longue durée. Alors, cet indicateur sera utilisé dans la suite pour la modélisation de la remise maximale possible sur le contrat en assurance d'essai. Alors, nous obtenons le modèle qui est basé sur des estimations linéaires de la remise maximale possible sur un contrat. Dans ce cas, nous définissons un niveau critique de l'indicateur de risque qui est le RUPCA, au-delà duquel aucune remise n'est possible. Donc, après cela, nous définissons un niveau de référence qui peut varier suivant le marché et qui est un niveau qui peut être fixé par un marché, par le marché et tout, et au-delà de laquelle aussi la remise n'est pas possible. Donc, grâce à la surprime, c'est-à-dire à l'état de santé de l'individu qu'on sort, nous avions fait des estimations linéaires afin d'écrire ces genres d'équations que vous voyez. Alors, la pertinence. Le commutateur offre une vision complémentaire sur l'évaluation des risques à partir de la table d'essai en facilitant le calcul du moment d'ordre du risque à accepter. Et pour donc effectuer toute remise à un client, il faut essayer de se maintenir dans une bande que nous avions appelée la bande de la remise. Grâce à ces éléments, nous obtenons le tableau présenté ci-contre où, pour des contrats d'1 million, suivant les divers âges, vous pouvez observer dans la colonne en rouge le niveau de remise maximale dégagé par notre modèle. Donc, si on prend par exemple l'assuré A1 pour 1 million dans 35 ans, c'est un temporaire d'essai et il se retrouve à 7% comme remise maximale. Donc, pour le management, pour la gestion du risque dans ce cas, le manager doit savoir qu'il ne doit pas dépasser normalement 7% s'il doit faire une remise au client. Donc, cette méthode de management des remises offre aux compagnies une vision prudentielle dans la gestion des couvertures d'essai en proposant une limite maximale afin de minimiser les risques de sous-provisionnement tout en restant concurrentiel. Nous devions aussi noter qu'après toute remise, le niveau de l'indicateur de risque par unité de prime commerciale ne doit jamais excéder le niveau critique. Alors, le cas de référence est une limite à définir sur chaque marché et pour l'organe en charge de régulation des marchés d'assurance. Alors là, nous présentons l'indicateur, vous avez deux tableaux. Dans le premier se trouve l'indicateur du risque par unité de prime commerciale avant remise. Et dans l'autre tableau, vous avez le niveau maximal de remise qu'on peut octroyer aux clients sur les contrats temporaires d'essai ou dégressifs. Donc là, vous aviez, par exemple, je prends un assuré qui a 30 ans. L'indicateur de risque pour une couverture d'1 an nous montre 12,6. Le niveau maximal de remise est de 5,45 à appliquer pour ce client. Le même client, sur une durée de 5 ans, l'indicateur de risque passe à 5,5 et on peut octroyer jusqu'à 17% de remise pour ce client. Donc, c'est une table qui montre le niveau de risque que nous commettons par unité de prime commerciale vendue en assurance. Et au même moment, nous donne la possibilité de voir le niveau de remise que nous pouvions appliquer aux clients. Pour conclure, comme contribution, il faut noter qu'ici, il y a eu d'abord dans ce travail la simplification de l'évaluation du moment d'ordre 2. Donc ce travail a permis de simplifier l'évaluation du moment d'ordre du risque d'essai, d'élaborer et d'analyser l'indicateur de risque par unité de prime commerciale émise. Et l'autre, de permettre l'estimation du niveau de remise maximale possible sur tout contrat d'essai en assurance. Et enfin, de produire des tables synthétiques d'indicateurs de risque par unité de prime émise et de rabais possible sur tout contrat. Il est donc à remarquer dans ces observations que les primes d'essai sont mieux quantifiées sur la table d'essai lorsqu'on se focalise sur la table d'essai pour les couvertures de longue durée et pour les assurés de plus en plus âgés, suivant la table de mortalité de CIMA. Et après, il faut aussi noter que la connaissance du niveau maximal de remise possible sur tout contrat offre aux pratiquants une vision plus rigoureuse sur l'application d'une part des risques encourus et d'autre part facilite la prise de décision technico-commerciale dans la considération de l'historique des assurés. Alors, c'est le moment d'ouvrir des réflexions plus profondes pour rendre plus efficace la question de remise afin de produire sur le marché une réflexion plus pointue sur le sujet de remise à accorder aux clients en assurance temporaire d'essai. Merci beaucoup.
So, hello everyone. This project is about a classification method of the non-life insurance claims. So, more specifically, no, the first slide. First one. So as I said, it's a classification method about classifying the non-life insurance claims. More specifically, it's a statistical inference-based approach to determine the attritional measure losses threshold. So, in actuarial science, we like such a term, classification, because it allows us to work on statistically similar samples. So, for each sample, we'll be applying its specific methods and techniques. So, non-life insurance claims could be classified into three major classes. The attritional losses, which are the claims with a high frequency, but with a little amount of loss. Major losses, which are the claims with a high amount of loss, but a low frequency. And the third class is the cut claims. So for the classification, the cut claims are the easiest one to be identified because they are related to events like natural catastrophes or human-made catastrophes like revolutions or civil wars. When it comes to the classification of the attritional and major losses, the task is harder because we don't have standards for what do we mean by a high frequency or a high amount of loss. For that, in practice, we are in practice we are setting what we call the attritional major losses threshold, which is the amount separating the attritional losses from the major losses. So for the exceedance of the threshold, any claim exceeds the threshold will be considered as major loss. So to determine So to determine the threshold, graphical methods are widely used. Here I'm showing you an example. Here it is, the hill plot. So the approach here is to identify the first point from which the estimator starts to be stable. Here we have the value of the estimator and here the ranks of the sorted data. So the threshold could be somewhere here, probably, or here. So the purpose of this research work is to implement an analytical method to challenge the graphical methods. Our analytical approach is based on the extreme value theory. Let's call it EVT for the next slides. We are setting two hypotheses. Each one is we are assuming that insurance claims losses are sampled from a right-tailed distribution. So we could talk about the concentration for the attritional losses with a little amount of loss and a low frequency for the losses with a large amount of loss. For H2, it's we are supposing that sorry. It's, yeah, for, H2 is that we are supposing that insurance claims are independent and identically distribution. This hypothesis will be required for the rigorous application of the EVT. So, our approach is motivated by the POT methods, which is an important part of the EVT. POT means peaks over threshold, which gives us an idea about the asymptotic distribution of the tail. We mean by tail here the observation exceeding a sufficiently high threshold. The asymptotic distribution is the generalized Pareto distribution, GPD. So we are setting a composite model for the claims data. So let F1 be the density function of the core distribution, of the head or the central part of the distribution. It's supposed to be a right tail distribution, let's say log normal or gamma distribution. For F2 is the density function of the tail, which is the Pareto distribution as the POT method precises. So theta here is considered as one of the model parameters. So it is determined by the maximum of likelihood function, maximum likelihood estimation. So the likelihood function could be written as follows. For let's suppose that M is the that M is the rank of the observation of the last observation under theta. So the observation with M plus 1 is the first one exceeding theta. So the likelihood function would be evaluating expressed by F1 evaluating by the observation from rank 1 to rank M, and F2 would be evaluating by the observation from the rank M plus 1 to the end of the sample. The problem here that we don't know which is the rank M to evaluate our likelihood function. So we have to follow the next algorithm. Step 1, we have to sort the data. Step 1, we have to sort the data. Step 2, we suppose that theta is in the interval xm and xm plus 1. X here is the claim amounts. So, and then evaluate the theta value by maximum likelihood estimation. Third step, we have to check if the estimation of theta is in the interval xm and xm plus 1. If it is, so the value of theta will be pre-selected. If it's not, the value of theta would be rejected. For the final step, we have to choose the value of theta which corresponds to the highest value of the likelihood function above the pre-selected value of theta. So for the key findings, here I'm showing you the application of two famous graphical methods, which are the Hill plot and the Pickens plot applied to the Danish fire data, which are data widely used in the research works. So For the determination of the threshold, I would choose beta 1 and beta 2, respectively, to the Hill plot and the Beacon's plot as a value of the threshold. So when applying our analytical method, the value of theta would be somewhere here. As we can see, the value of theta is not likely to be guessed by the graphical methods because it's in an unstable part of the graph. So now let's take a look at the histogram of the data. The first observation here, we have a right-tailed distribution. So our first hypothesis, H1, is is retained, yes. So here the value of beta 1. And here we have the value of theta. This. Yeah. As you can see here, beta 1 corresponds to an amount of claim with a not negligible probability of occurrence. And that's not the case for theta. So beta 1 couldn't be retained. And theta seems to be more likely the appropriate value of theta, of the threshold. So the next table shows us the impact of the choose of the value of the threshold. Here we have the standard deviation of the measure losses and the standard deviation of the attritional losses for the two values of the threshold. As you can see here, choosing beta 1 could lead to an underestimation of the volatility of the claims. So which could impact the other threshold-related estimations, like, for example, for the risk-based capital, the premium SCR would be underestimated. SCR means solvency capital requirements. And for the IFRS 17, for example, the risk adjustment could be underestimated also. So, for the managerial implication, we are highly recommending the threshold stress testing. So we could identify how a change in the value of the threshold could cost us in terms of, for example, a premium SCR or risk adjustment. We highly recommend also the to challenge the graphical methods to the analytical method. And finally, we recommend the study of the threshold stability and consistency. So we could determine which is the more appropriate method for our portfolio to be used to determine the threshold. Consistency here could be evaluating by the backtesting of the volatility of the measure losses, comparing the estimated volatility to the realized one in the next years. So, for the value of the research, our method is likely to produce more accurate results, as it aims to identify the point, the point corresponding to the most significant change in the volatility of the claims, to switch from the head of the distribution to the tail of the distribution. And it offers also the possibility of the task automation, especially for large portfolios with many LOBs, line of businesses. It could make the task more easier. For the limitations, we have to signal that the Danish fire data are collecting from 1980 to 1990, which is kind of old data. And what we have noticed in the new portfolio data, for example, for 23, is the tail of the distribution is more heavier. Is heavier than the Danish fire data. For the second limitation, the hardware requirements. As we have seen, the algorithm needs to apply the maximization, the optimization algorithms for all the data points of the sample. So if I have if we have a sample with n observation, we have to apply the maximization algorithm n-2 times, which could take a lot of time if the hardware are not required, are not appropriate. To conclude, we implemented a method, an analytical method, to challenge the graphical method by controlling the incertitude on the results and by controlling the subjectivity allowed by those appreciation-based approaches. But we are not saying that an algorithm could change or could take the place of an analyst. Thank you.
Two.
Okay, just a brief one. I wanted to find out, you are talking about part of your recommendation, you are looking at accurate results. So my problem is, how are you testing such a kind of an assertion? Did you do any statistical test, or you are just saying, or you are just talking about accurate results?
Sorry, I thought the question is not for me. Could you repeat, please?
One part of your recommendation is that the method you are choosing is to give accurate results.
Mm-hmm.
So my question is, are you doing some statistical test, or you are just concluding such? How did you arrive at such kind of...
For the consistency of the methods?
Yeah, how do you establish consistency?
I just mentioned that we can backtest the volatility of the major losses by comparing the estimated volatility to the realized one in the next few years.
Because my problem is issues to deal with the accuracy. It is just not, I think you need to do some tests.
Yeah, like backtesting, for example. No?
I was just wondering, because I didn't see anywhere you have done any test. So it is just a wonder, because you know, to qualify a statement like accurate results, then it must have been passed through some battery of tests here and there. So I was just wondering, but it is okay if you have established that.
Yeah, if the results are stable, that means that our method is appropriate. Am I getting the question? Or?
I think I'm all right.
1, 2. Thank you, Mohammed and Wilfred, for your presentation. My question goes to Mohammed, and it's about complexity. I think as professionals, anytime that we advocate for more complex solutions, we have to use it sparingly because we have stakeholders who might not be as technical as we are. So let me propose a different methodology, and then maybe you can help me understand how your methodology is better than that. So to find a threshold that is not very volatile, what I've seen done in some industries is you would cap at different levels. So you can cap at, let's say, 100,000, right? measure the variance, cap at 200,000, measure the variance, cap at 300,000, and so on and so forth. And then you can plot a graph of the cap and the volatility, and then you would see which one has got a leveraged effect, right? You will see that point if you want to. So how is this simple method, how is your method better than this simple method that some other actuaries use?
So if I, you are proposing to fixing a various value of the threshold, and for each value we are calculating the volatility. And so
yeah, so you have the data, right? You can cap at 100,000.
Yeah.
Measure the volatility of cap loss at 100,000.
Yes.
Cap at 200,000. Measure the volatility. Cap at 300,000. Measure the volatility. So now you can plot cap by volatility, and you see the relationship, and then you can select a threshold where, there's going to be a point where if you go above that threshold, volatility would explode, right? And that normally guides you where to select the threshold at. How is this? It's simpler than your methodology, and I want to understand, why should I choose your methodology? Because it's more complex. Why should I choose your methodology rather than this simplistic approach?
Yes, indeed. There is a methodology which is similar to what we have said. Just you said, which called the Grattan's graph plot. So the problem of this approach, that we don't have a metric to identify the threshold. We are not supposing to choose the value of threshold corresponding to the higher volatility, because we can overestimate the volatility if we choose that value. Are you agree with me, or?
We can take it offline. I don't want to derail the process.
Okay. Bon après. Ok. Bon après-midi. J'ai une question pour Monsieur Wilfried Couton. Ok. J'ai trois petites questions par rapport à votre développement de tout à l'heure, ce qui est très excellent. Alors, premièrement, j'aimerais savoir si c'est déjà mis en application, et si c'est oui, est-ce que ça marche, quelles sont les difficultés rencontrées, aussi bien au niveau du Bénin que de la zone ciment. Et deuxièmement, j'aimerais savoir si vous avez déjà réfléchi, ou s'il est possible de faire ce genre de recherche pour les assurances IRD, qui du reste peuvent connaître aussi le même problématique. Et puis finalement, vous avez tablé votre étude sur les tables TD de la zone ciment. À moins que je me trompe, aujourd'hui vous parlez plutôt de tables F et H. Est-ce que ce n'est qu'un exemple, ou vous allez adapter cela aux nouvelles tables? Bon, nous, on n'est pas de la zone ciment, nous venons de la RDC. Donc c'est pourquoi je pose ces questions. Merci.
Merci beaucoup pour la question. Nous l'avions déjà utilisé, ça s'utilise déjà. Je l'ai expérimenté à Sono Assurance Vie Bénin et aussi à Atlantique Assurance Bénin, où j'étais le responsable technique. Nous l'utilisons fréquemment, même avec d'autres assureurs, nous l'utilisons. Et comme difficulté, et généralement dans les tractations commerciales, on est des fois obligé, des fois forcé même des fois pour dépasser les limites critiques que nous avions fixées ou bien que le modèle a pu faire se déterminer. Donc c'est un peu ça les difficultés que nous rencontrons dans la pratique. Sinon, je crois qu'avec le modèle, ça s'adapte à toutes les tables. Il suffit de mettre la table et puis nous programmons l'algorithme et ça fait tous les calculs automatiquement. Et ça dégage, ça fait les comparaisons, ça fait les ratios de risque et en même temps, ça dégage les taux de remise applicables par âge sur la durée des contrats. C'est le plafond. Sur le TD, quand ça marche, et je crois que déjà avec les dégressifs, ça c'est bon. Ça marche sur les dégressifs parce que le TD, le capital sur risque étant constant et de l'autre côté, c'est dégressif. Donc, avec le niveau maximal sur le TD, ça généralise déjà ce qu'on peut observer sur les dégressifs. Merci.
Okay, I have a question for Mohamed. For your composite distribution, what does the small c stand for? Is it an adjustment parameter? What is it?
So,
and
sorry?
the small c.
Ah, okay. The small c is a normalization constant. So the integral of the composite function would be equal to 1.
Okay. And most of the time when it comes to research, and this one is kind of estimation. So you look around what has been done, like the other guy behind me was saying. You look around, you see what has been done, and then to compare the consistency. You know, you can not just say that it's stable, it's not enough. Okay? And I have one more question. What if, you know, in your sample, you have, you know, they are weighted, or you have complete or incomplete data? So how do you deal with that? How do you adjust that one to your model?
If we have incomplete data?
Yeah, if you have incomplete.
What do we mean by incomplete data?
What I mean by incomplete data is like you have kind of franchise, right?
Franchise.
Yeah.
Non-proportional reinsurance priority?
Yeah. Like retention.
Yeah, we have to consider only our parts, not the total amount, only our parts.
Okay. And what if it's weighted, in your example? You know, all the data, you don't have the same weight. So let's say the weight are different. So how do you deal with that? How do you adjust your likelihood function?
Sorry, I'm not getting it, sorry.
You have example, right?
Yeah.
Because you are saying the size of the example is n, you have small x1 up to small xn.
Yeah.
So that means you have the same weight for all the individual in your example. What if it's not the same weight? Like for x1, you have w1, x2, w2 up to xn, wn. So how do you deal with that? And it can happen, actually.
Yeah, non-life insurance claims are supposed to be not at the same weight. They are supposed to be sampled from right-tail distribution. So for the little claims, we have big weights, and for the large amount of for the claims with a large amount of loss, they are supposed to be less probable than the other. So by definition, or by construction, the data couldn't be at the same weights. And that's how we are determining the value of the threshold. The change of the volatility between the center part of the distribution and the tail of the distribution.
Okay, thank you.
Thank you.
Merci, Monsieur Wilfred et Monsieur Mohamed. A round of applause for them, please. It's been a really long day. And thanks so much to all of you for staying through the first the opening ceremony, and listening and contributing to all the engaging topics delivered by our presenters. Tomorrow is another day for us to engage, share ideas with a twist of entertainment. We started with an opening prayer, and as we do in Ghana, we end with an opening prayer. O God, our help in ages past, our hope for years to come, accept our thanks for ensuring a successful event today. Amen. I wish all of you a safe night. For those of you who want to step out and tour Accra. Enjoy the nightlife of Accra. Tomorrow we meet here at 7 and we start deliberations at 8:30. Thank you so much once again, and good night.